I would like to kick off our session today by introducing Meg Bodie, the president and founder of Talking Hedge Events. Meg, over to you.
Wonderful. Thank you, Ken. And hi again, everybody. This is a real pleasure to welcome you to our fifth in a series of 6 webinars, making up what would have been our visit to Santa Monica, which unfortunately couldn't happen. But at any rate, we're rolling out some great discussions. Today we have, and really, it's really an embarrassment of riches. We have just an outstanding, stellar cast of panelists with you today. We're very excited about this one. Just quickly, I want to thank all of our sponsors: Crable Capital, InfraHedge, a division of State Street, Aspect Capital, Bodie Research Group, Camden Asset Management, FAR Capital, InnoCap, Martlet Asset Management, Row Asset Management, SLC Asset Management, TD Securities, Vidrio Financial, and Welton Investment Partners. Also like to thank our association partners, AMA, CASA, Kaya, and Cal Alts. Happy to have a nice relationship with those associations. I just want to mention before I turn it over to Ranjan that we would normally be operating under Chatham House rules. So what goes on here today, the information, the opinion that you hear from our various speakers really reflects their own thoughts and insights, not necessarily those of the institutions for which they work. So I'd like to start inviting everybody on. Ranjan, why don't you flip on your camera?
Excellent. And I echo Meg in thanking the sponsors. And most of all, I thank all of the audience. And Meg Bodie has really put together a fantastic body of work. And this webinar is part of a series for a conference that would have been in Santa Monica. The title of the previous webinars in terms of the anthology of this series is Customization is Key, Delivering Bespoke Solutions to Institutional Investors. And this webinar today is entitled Dealing with Unpredictable Markets, What New Solutions Are There? And so obviously a very timely and interesting topic. And I am going to ask each of the panelists to introduce themselves, starting with Judy.
Great. Thank you, Ranjan. So I'm Judy Poznickoff, the managing director and one of the founders of Martlet Asset Management, a small investment firm located in Newport Beach, California. We're working on several research projects right now, and I'm formally one of the founders of PAMCO, or Pacific Alternative Asset Management.
Thank you. Brian.
Morning. I'm Brian Broadway. I'm located here in Richmond, Virginia, and I currently serve as the president of a multi-generation single-family office. And I head up all of our efforts regarding asset allocation, manager due diligence, a little work on the philanthropy side. And my background is worked in the family office space and for a well-known commodity trading advisor at Chesapeake Capital for a large part of my career. And I'm happy to be here as well.
Excellent. John?
Hello, Ranjan. John Linder, out of rural Oregon here. I am a managing director with SLC Management, a organization that is the asset management, third-party asset management arm of Sun Life Insurance out of global insurer out of Canada. SLC Management is focused on income-oriented solutions that can that are typically used by insurers and/or pension systems. So everything public to private before you get to the equity tranche.
Thank you. And Rafa.
Hi. Hello, everyone. I'm Rafael Silveira. I'm part of LGT Capital Management. We are a big alternative asset management company based out of Switzerland. Our focus has been over the years on private markets and also on hedge fund strategies. I'm head of client solutions for North America, and I basically take care of our mandates. Those are, in general, multi-alternative, focus on a range of asset classes. Before LGT, I used to work at AQR. Before AQR, I was at JP Morgan Asset Management on the multi-asset solutions. Before that, at Bank of America at a prop trading desk when I finished grad school. And I'm based out of Greenwich, Connecticut.
Excellent. So definitely an all-star panel. And again, I'm Ranjan Biduri, CEO of Bodhi Research Group out of Toronto, Canada. We work very closely with family offices, pensions, sovereigns in due diligence and research, portfolio management issues. And I'm very honored to also state that Brian Broadway is a client of Bodhi Research Group. So now, fact is sometimes stranger than fiction. And I think that's an old saying, and it's very true for 2020. I mean, I don't think anybody could have predicted what happened in 2020. Like if you think back a year ago or 2 years ago, how crazy this year has been, all the different kinds of things happening. That Billy Joel song, "We Didn't Start the Fire," could have been just about different things happening in 2020. And obviously the global pandemic has been the biggest, has ramifications all over the world. And but it's also been the U.S. election, the U.S. election result now. Some folks, including President Trump, contesting whether the U.S. democratic system actually works. So there's a lot of chaos, a lot of unpredictability, and it's and then everybody on this call knows what happened in March of this year. And so it's been one of those years where 1 year of this experience is sort of like dog years, where you're gaining really 7 years of experience. And I think what I'd really just like to start with is what have your experiences in 2020 been with regards to clients, the portfolio, or insights learned? And Judy, I'll maybe ask you that question.
Sure. Well, I think it's interesting because previously working at PAMCO, with the fund of funds and clients invested in portfolios of hedge funds, one of the things that we always, or at least I personally was always looking for, was a pickup in volatility, because for such a long stretch of time, things were in some sense, at least on the surface, as measured by the VIX, so calm. And in fact, I actually looked it up. If you go back to a year ago, the VIX was at 13. So, it's amazing, what a ride it's been this year. We're about 24 right now, and the peak was 89 on March the 16th, 2020. So it's really been a rocky ride there. And then obviously the vol of all has obviously picked up. I think the interesting thing as well is to go back to the other Friday, the 13th of this year, which was March 13th, a Friday. And I think to me, that's where it's sort of the real implications of what was going on really started, because volatility had started to pick up, certainly in February of this year, but it wasn't really dramatic. And people were talking about the virus, particularly how it was impacting China, Wuhan, and so forth. And I even knew a couple of people, even in early March, that had traveled to China for work purposes and had come back and had been very, very sick, but hadn't realized what was going on. And then obviously subsequently tested positive for the virus. But you go back to March 13th, and again, it was a Friday. And I remember sitting here in the office with everyone watching the TV, and Trump was speaking at a press conference about how the virus would be under control, everything would be fine. And you just watched the market go up and up and up and up till it really sort of was a straight line there, the last few minutes of the trading session that day. And then over the weekend, things sort of reversed. The Fed came out with a surprise rate cut, which the market reacted negatively to. And then, the market was down, in the futures, and then opened down. And then we were off to the races that week for what was a very, very tough week. And for us in California, where the first sort of work from home mandates came out, it actually proved pretty tough because we did all right in terms of the work from home, as did most people, but working with a lot of the counterparties where they really had no notice and we're all at home, actually proved to make it a really difficult week in terms of getting a lot of trades off and so forth, because they were just sort of rushed and, sometimes their systems weren't working as well as they could, but things actually worked out. So it's interesting. I think people were surprised by the volatility and how quickly it came. I think they were surprised as well by the impact that, it did eventually go quite smoothly. The working from home aspects had on trading and so forth, and the exchange of information. But, we sort of came through it. And I think the thing to do is, has that helped us and strengthened us for the next time something like this happens, the next big bout of volatility, or will it also be a surprise then and we won't be able to react to it?
No, thank you. Thank you for that synopsis. And it is a situation where during that very prolonged low vol environment, was quite a few hedge fund managers that were stating that, their strategy can do a lot better if there was more vol in the markets. So
exactly.
And some definitely delivered, but there's been a whole lot of dispersion in the hedge fund universe. Now, Rafa, you work with a lot of different kinds of clients at LGT and a lot of customized kind of work. What have your experiences been in 2020 with regards to clients, portfolios, or insights learned?
Yeah, so this, has been an extremely interesting year. We see a range of clients, but as we discussed, I basically break them out in a couple of groups, and that makes things a little bit clearer to think about. So you have on one hand, family offices, endowments, sovereign wealth funds, a little bit more absolute return oriented, at an individual level as well. Those guys tend to focus a bit more on return, not really hedging liabilities per se. And equity beta turns out to be a really, sometimes hidden, sometimes really clear risk on their portfolios. And then on the other side, you have, pension funds and people that carry a liability, and they sometimes have a portfolio more catered to fixed income assets to kind of hedge a little bit that duration mismatch. I would say both of these groups this year were surprised, both on the bad side and the good side in some ways. Of course, equities did what everybody here is very familiar with. With the magnitude, point number one, and also the speed. This on the public side, peeking a little bit under the curtain, when we look at the private assets that we have a lot of exposure to, we've been relatively pleasantly surprised, I would say, so far this year. There were a lot of uncertainty, Q1, Q2, but what we've been seeing lately has been positive, if you think about private equity, private debt, real estate, also with a lot of dispersion within real estate in particular. And then when you look at the hedge fund universe, as you mentioned, Rajan, a lot of dispersion. What we at LGT have been focusing on is really on clarity, on quality, and then also on what we can do well in-house in some sense. So, out of the gamut of strategies, what we were a little bit unsatisfied was with risk sale protection. The options we saw in the market, we decided to implement some of that in-house. We can talk about that. Also with the new technologies with machine learning, AI, we were also a little bit, thinking about what could we do in-house as well. And one aspect we focused a lot was on transparency, and we can deep dive into that. But I'll pause here just to let the conversation go, and then we can go back to these.
No, thank you. Thank you both, Judy and Rafa. And as I mentioned, the title of this webinar is dealing with unpredictable markets. What new solutions are there? I think we're going to start maybe by talking about not a new solution per se, but maybe something that is very known to all of the audience, I'm sure. U.S. Treasuries, and so before trying to go into new solutions that might involve a lot of complexity, what is your opinion regarding invoking U.S. Treasuries as a protection in a flight to quality? And John, I'm going to maybe ask you to delve into this topic please.
Thank you, Ranjan. As a former consultant with PCA, which is now Makita, what we always came back to, and what I think is reasonable to come back to, is strategic allocation is going to be is kind of prologue to how you're going to do as an entity. And treasuries over the past, forever, ever since the U.S. became, left the developing market stage in the 1800s, has been a mainstay of many portfolios, and at the end of the day, has responded, as a stable asset with a positive carry, and has had negative conditional correlation to equity drawdown. So fantastic, right? Who wouldn't want that, right? A positive carry asset that has a negative conditional correlation, or basically responds positively when equities are drawing down. However, of course, we know today that treasuries are yielding, 1.6% on the 30-year. So yes, it's a positive carry if rates don't change. However, the question, one should be asking, and a lot of clients and a lot of institutions and market commentators are asking, is will the Treasury remain the flight to quality asset? We as an organization certainly believe that yes, the flight to quality aspects of long treasuries are going to remain intact. And so the question, and we have various reasons for that, believing that. But so the question would, in our mind, is really, how do you deal with the fact that now a significant portion of your portfolio, if you have ag as your underlying fixed income allocation, is yielding less than 1.5%. Is it feasible to meet your other objectives with that? And I think it's a very valid question. But we believe that treasuries are going to continue to act as that flight to quality asset. So react when treasuries are drawing, or when equity markets are drawing down, we expect treasuries to rally, whether that's from 1.5% to 75 basis points, or 5 to 4 in the past.
Got it. No, well, there's a lot bundled in there. It's definitely low interest rate environment, because in some places on the planet, negative interest rate environment, the potential for maybe, and we'll talk about this later, is potentially if inflation rears its head. And you're absolutely right in that it's definitely case by case in terms of trying to ascertain whether, from the asset allocation perspective, treasuries can really have enough of the return to avoid the asset liability mismatch from the institutional investor's perspective. And one new development that I'll mention to the audience, because it's somewhat related here, is that a group of pensions, CalPERS, HOOP, SWIB, and Ohio State's pension, they formed an association called Global Peer Financing Association. And what they're doing is peer-to-peer lending, and in order to sort of maximize or optimize their balance sheet. And it's really looking at the liquidity management, cash management, and repos and so forth. And that's been a very new development that could have a profound impact in a positive way for our industry. So I'm going to pivot a little bit now and to Brian to sort of ask Brian what he's seeing from the family office perspective. What are the in 2020, what have family offices in general been speaking about, thinking about, and so forth?
Yeah, thank you, Ron John. I appreciate it. Again, it's good to be here. I think one of the lessons I've learned in my career is if you've met 20 family offices, you've met 20 very different family offices. They're not none of them are exactly alike, and how they think about and process and navigate investing is all very, very different. But there are certain themes that I have sort of come to realize and understand, and as I talk to friends and cohorts around the country, and one of them is in 2020, certainly the first quarter, family offices didn't really understand the risk profile of their portfolio. And I think that whether it's through liquidity or how much beta they had, one of the themes is there's a lot of hidden beta in family office portfolios. And some of it they may have claimed to understand, but most of them, I would say, didn't. And there's also this nuance. I had a conversation with a good friend. He's actually based in Toronto, Chris Schindler, who is really a star and a seminal thinker in this. And Chris and I were talking about the difference between a diversified and a diversifying manager. And I think a lot of family offices had what they thought were a diversifying manager, and it really wasn't. It was a diversified manager, but just tons of hidden beta. So I think family offices are trying to navigate that, understand that. And what I also saw, the response this summer was two very distinct paths. One was get in the foxhole and just wait till the volatility settles down, when there's more normalcy, if you will. And another very distinct path, which is few, but there were a number of them that said, let's go searching for opportunities. Who out there has actually done what they said they were going to do, and only what they were going to do, and perform through this portfolio? Because a lot of times managers historically were punished for doing the right thing. They were punished for following their systems, for investing as though they had said they were going to invest, and may have had some whitewater along the way, but really shined in March, April, and May. So finding those managers that are truly diversifying for their portfolio, that did what they said they were going to do, and for these family offices to recognize that their portfolio probably had a whole lot more beta in it than they recognize and they understand. And then how does that affect 2021? We can talk about that down the road. So one of the themes is the hidden beta. And one of the other themes I begin to see is this search for finding something that's different. And we can talk about what is different, whether it's on an absolute or a relative basis. But this quest for different is something family offices always say they are in the midst of. But I would say and confess that most family offices really struggle with recency bias. What has worked really recently and what is a good story. And that's where they're going to pile in. And they sort of forget about what the tail risk might look like, or forget about what the beta might be. So it's been a real interesting journey, and it's been great to talk to friends around the country and hear sort of how they navigate that and some changes that they're making.
Thank you, Brian. And I think, John, there was a lot that you stated in there, and I'll make a few comments, but I first would like John to share a few thoughts.
Yeah, thank you, Brian. I really appreciate that. And I would say pensions and family offices are probably more similar in their asset allocation than different. But what I guess my main comment would be that anybody who has a return expectation in the 7% range, they need to recognize that the vast majority of their risk is typically equity oriented, or not necessarily equity, but effectively, if the economy comes to a full stop, almost everything on a risk basis that they hold is beholden to economic growth, and therefore they will have a full stop on anything that is, equity oriented, or growth oriented. And the only thing really that with certainty that is not growth market oriented is sovereign bonds, because they basically their rate does not vary with economic growth. In fact, rates tend to fall in a full economic stop. So I it's really important that all pensions, all organizations that have a significant rates of return, ex insurance companies, because they're not permitted really to invest in a lot of equity oriented stuff, really need to recognize that the vast majority of their risk allocation is going to be economic growth oriented, and therefore when there is a full stop, and we don't know when it's going to happen. We don't know where it's going to come from. The world is unpredictable, as Judy indicated. But they will suffer profoundly, and they have to recognize: are they able? What does their asset allocation, what does their risk allocation say about their losses, and can you handle that?
Yeah, there's so much packed in there, John, and let's just maybe talk a little bit about some of the ideas that both Brian and you just raised, and in some ways it dovetails with some of the earlier statements by Rafa and Judy. But the piece about did your investments behave as they were supposed to behave? There's a problem if you have a credit manager and it went down 30% in March and you didn't think that was possible, right? Either that is a situation, and the credit manager may or may not have done anything wrong per se, even though that's obviously an undesirable return. But there is some kind of lack of communication or understanding if such a incident occurred. Now, a lot of what we're trying to, we're supposed to be talking about is new solutions. But John, you really, got to the heart of the matter, is that it is, and same with Brian, in terms of it is about portfolio construction. And it really goes to, what Brian was referring when he was referencing Chris Schindler. And this is making sure that you're getting truly diversifying investments, and to avoid that phase locking. So if the correlations in a flight to quality, if two investments usually are uncorrelated, but now they become highly correlated, it doesn't help you, especially if it's going in the wrong direction. So all of this leads to very, very practical and prudent portfolio construction, understanding the asset allocation, understanding, the different kind of scenario analysis and stress testing, and doing a battery of different kind of analysis on different correlation regimes, right? And I recommend to the audience a book on correlation that was published last year by Gunther Meissner. The whole book is on correlation, and it's to me, it's a must read for anybody who's constructing a portfolio. But I'm gonna ask, gonna go back to Judy, because I know that Judy has a lot of expertise in the factor investing, and in many ways, when one looks at the factors, it's in some ways they're from the factors you can build a lot of these kinds of different returns. But obviously, value factor had been sort of, in hibernation. It recently had a recent reincarnation. How hard is successful factor timing and calling factor rotations, Judy? And what's your insights on that?
Well, my insights are that it's actually very difficult to factor time. But before I go into that, I'd actually like to go back to a couple of the things that Brian said, and then also John as well. Because what I find interesting is Brian's sort of last comment about people like stories. And I think that's one of the hardest things with a lot of the diversifying strategies, the things that are truly different, is that there is no story that you can attach to it. You can't talk about, finding this undiscovered equity or, really fighting it out through the bankruptcy system on a particular credit or something that people can actually latch onto and sort of understand based on their sort of day-to-day experiences. Most of these things that are really different are different, and they're difficult to understand. It's tail hedging, it's options, it's, all kinds of different things that even for a lot of very sophisticated investors is something that they may not really be that familiar with or that comfortable with. So they tend to shy away. And when they do make an investment there, the problem is that, it's typically a negative carry and they don't like it. They pay it, and then they get tired of paying it. And that tends to be just about at the wrong time. And we saw that this year in a lot of the press articles about CalPERS in particular, cutting back a tail risk program that they had sort of at the wrong time near the end of 2019 and into early 2020. So I think that's something that's really important that everybody should recognize, that different is different because it's hard. And that, there's no story attached to it. There's nothing to sort of make it applicable to your day-to-day life. And that's really hard for allocators to really get a sense of.
Well, this is something that is actually really, really important for our industry, right? Like there's something problematic if somebody has a fiduciary duty in constructing a portfolio with the asset allocation doesn't, it's okay whether one wants to have tail hedging or not have tail hedging. Either you can construct a robust portfolio and meet your, investment objectives. But if you are putting one in, you should really be understanding that, understanding the risk return profile of this. And to me, it's alarming that consultants as well as the asset owners are sort of stumbling upon, this kind of mistake. I mean, there have been other pensions that were selling vol and got caught in March, and these are rookie mistakes. And so, I mean, I think most groups have done very, very well in having a very proper process and a lot of governance, and it's been a highly unpredictable year and a very difficult year. Like if one looks at what happened in March, the equity markets went down 10 times faster than it did in 2008. And so, but what else do any of you, I'm going to just, it's an open ball. How do you deal with unpredictable markets?
Ranjan, if I could just jump in here for 1 second. I'll Judy, to your point, I'm going to push back a little bit on this idea of, if we move away from equity beta, we're kind of into this realm of uncertainty and we don't know what we're really getting ourselves. I think there are some managers over the years, and especially in the quantitative space, and you're very familiar, did a really good service on explaining what exactly the premiums are they going after. May work or may not, and they kind of brought this to more of a the plain understanding of a lot of investors. And I see, for example, machine learning, AI, I touched that in a little bit, really on the early stages of this. It's potentially beneficial, it's good. We don't know exactly what are the premiums that are being harvested in most of the cases, but we're going there, right? I gotta say, I'm an economist by training. Understanding the economic motivation of a certain strategy is totally key. And I think, John mentioned economic growth. How do we link that to either premium, merger, or, what are we actually harvesting there? And I think investors need to understand that so they can utilize correctly on their, know exactly what is the function that it plays on their overall portfolio. So when Brian is picking somebody, he needs to understand what is the function that will play. So anyway, I think that's very, very critical point to keep in mind. To John's point a little bit earlier on fixed income and treasury in particular, of course, my sample is biased because I'm on the alternative space. So I see what I've been seeing is folks that kind of are moving away, John, a little bit from fixed income at this point and not so excited about yields and also not so excited about the correlation structure, to be fair. So, you've definitely heard the term of, return-free risk attached to some of these assets. And they're like, look, there's a couple of scenarios that we can look out. One is an inflationary scenario, which is not that great for my fixed income portfolio. The other one is, we kind of muddle along and be where we are. And that's not going to be very helpful either. So what I've been seeing, and again, very broad in terms of asks that we get, but is, okay, where can I get some yield that is not really attached to traditional treasuries, and what is opportunistic? So the opportunistic thing, I think, is really broad because, first of all, it's a very undescriptive word, but a lot of people want to understand exactly, going back to our point, something that will work, that I understand the premium, that is not equity beta, because that, let's say 6 or 7% return, if it's not equity beta, it's really valuable. If it's equity beta, then it's not that much. So,
and I want to jump in here. I'd love to find this 6-7% return doesn't have any correlation to equity. I guess that's my main point. It's very, very difficult to find something that doesn't effectively have a correlation to equities.
I would point to managed futures and diversified trend following, and invoking structural alpha and looking at like the Littner Revisited. Not enough portfolios have enough managed futures in it. Not enough portfolios have.
That's a great point. That's a great point.
And then there's structural ways to access this. But what I want to do now, because even though we're speaking virtually from all different parts of the planet, let's try to make this a little interactive in the sense of with the audience, which is a phenomenal audience. We have, thanks to Meg Bodie, we have some poll questions. And if I could ask the audience to already answer those questions, and then maybe we'll ask the panelists as well, because all of these things are being brought up already. So, was your portfolio prepared for 2020's volatility? Yes or no? So in the audience, please answer.
Hey, Rajan.
Yes.
I just want to kind of echo what John Rafael has said. I think that family offices, one of the things that I, given my background and having worked for a CTHSP Capital for many years, I really carry the banner for diversification, this idea of convexity, and the role that a manager that is trade stocks, bonds, currencies, commodities, has this positive convexity profile can really be beneficial for a portfolio. And sometimes, as I think we've already mentioned, you can get punished for doing the right thing, and encouraging people to do the families. And often I'm the only one going, here's a list of diversified trend followers, and these guys have been around a long time, and they have proven their merits in a portfolio. It may not be popular, it may not be a great story, but gosh, in periods of unpredictable volatility, it's just really nice to have some in your portfolio. And sometimes that's a hard sell. In fact, I've gotten not booed, but I got the visual boo when I even talk about active management. I mean, sometimes, a year ago I was on a panel and they're like, active management, trend following, you're crazy, Well, and then March happens and April happens. And so it's helpful to hear some other folks that see similar, feel the same way in different parts of the investing universe.
And Brian, I want to comment. Probably the most helpful way to explain it, in my opinion, is inversion. Like, what is your Achilles heel, right? If effectively an institution has to ask themselves, what is my Achilles heel? What will kill me? What can I not bear? And then they're much more likely to go through the process of figuring out, I can't suffer a 50% drawdown. I don't know what their threshold is, right? And they recognize that if they have, a certain amount of quote unquote equity exposure, or growth exposure, and they have nothing else on the other side, that's completely feasible, completely possible. And then they start, really thinking, well, maybe I don't want that. What can I put in place that is going to counteract?
Yeah, I mean, I think that, and I sort of jumped the gun a little bit. I apologize. I didn't realize that I had to call the poll up. So we're giving the audience a little bit of time to answer these questions. I was going really high frequency. I think I just got excited because of all the interesting discussion that's been going on. by all of you. And so I apologize, but again, I encourage the audience to answer that. I think, at the end of the day, this kind of, one has to look at the portfolio both as a whole and then obviously at a granular level. But at the whole, you're really, each investment has a role within it, and you're looking at the different kinds of scenario analysis and stress testing. And I earlier this year, Bodhi Research Group had the pleasure of getting to speak to 36 different real risk experts around the world. Like, these are for chief risk officers at sovereigns and so forth, to sort of understand how they were looking at their CIO risk, portfolio at that kind of level. And really, though, it all comes back down to the basics, that what you're all speaking about. So it is, on one end, it is a lot of hard work, and it is a lot of, it's a very important responsibility. On the other hand, it's not necessarily as complicated as one might think. But
well, the more complicated it is, the more likely it is to fail. Meaning, not you can have lots of things in your portfolio, but when a crisis hits, it's going to go one of two ways, or flat, right? So basically, there's first order effects. Okay, is it growth related? No. Okay, then it's not going anywhere. Is it rate related? It's going to go up, and if it's growth related, it's going to go down. Okay, if a CIO doesn't understand how they're positioned with their strategic today, if the market opens 20 points lower tomorrow and they don't know what their portfolio is going to do, they should be fired.
Got it. No, I agree. So let's, maybe while we're waiting for the poll results to appear on our screen, and then we can discuss that. Here we go. Just as I stated it. So maybe let's share these results. Can all the panelists see it? So what was your portfolio prepared for 2020's volatility? Almost 2/3 said yes. Any comments from the panelists on number one? Okay, so number two, what kind of explicit hedge or crisis protection allocations did your portfolio have? And it looks like it was pretty split, between tail hedge strategies being 30%, long duration treasuries almost 20%, managed futures 30%, and extra cash reserve at 34%. And
so it looks like they could have chosen any of them. So basically, a third maybe had crisis protection of some sort. Am I reading that correct?
That is correct. Tail hedging. I'm pretty surprised that 31% had tail hedge strategies in place. So that's encouraging. Any comments from the panelists? So I'm just going to go one by one on this, and feel free to jump in, please. Did you opportunistically take advantage of the volatility either in March or the pre-election day? Or I'll add, to the panelists, because obviously that wasn't embedded in this, but just when the equity markets crashed, if you had a bigger cash reserve and more liquidity, did you opportunistically pick up some good deals? And so any comments on any of this? It looks like it was split 50-50 almost. Between.
I mean, at the expense of talking too much, I'll be quick here. I like to think of first, second, and third order effects. First order effect is what happens the day that the equity market goes down 10%. Your strategic allocation will tell you exactly what will happen. Second order effect is, are you able, do you have strategies that can effectively position based on that movement? Those are your trend following strategies. Those are your tactical strategies in liquid markets, because effectively you can't reposition in front of something you don't know is coming, but the next day you can. And then the third order effect would be, what dry powder does first order and second order provide you to reinvest in the things that just got absolutely creamed? So if you don't have first order or second order, you can't execute on third order.
I'd just add to that that I think the poll results are actually quite encouraging, and actually sort of fit with what John was just saying, because it may be a very biased sample, and it probably is. But the fact that, about a third had tail risk protection, a third had excess cash and were able to opportunistically take advantage of the market moves, that's a really encouraging sign. And the fact that they also had long duration in the portfolios.
There is some sample bias in this poll because it's a smarter audience because they're smart enough to dial in for a Meg Bodie seminar. So.
Yeah, I would say that many of the family offices I deal with, they would not respond like that. I would say one of the real themes, if we were having this call a year ago, one of the themes that I think you would see is family offices, big and small, love private equity and their search and their reach for yield, private equity, this non-mark-to-market nonsense. Well, I shouldn't reveal my biases, but private equity, it's just my previous training that just comes out. It's just, I looked at it as illiquid leverage beta. And that's a no-no when you're on the West Coast and you're talking to family offices, that's all they have, right? They have passive management and lots of private equity. People just piling in thinking this is great. And then March happens and they're like, oh my gosh, like this is crazy. The market freezes up. It's illiquid, all these things. So I feel like families, not all of them, obviously, I don't want to paint with too broad strokes. That's very dangerous, of course, but loved that. And it's a great story and they're trophy hunting and it's something besides just piling more into the equity markets. And I would argue that it really was, and just felt and maybe looked a little bit different. And I think family offices tend to move in herds. And so you saw this massive embracing of private credit, private equity. It's all this great stuff. And then March and April hit, and that's just, so I wish that more families were as sophisticated as you guys are talking about. But most of them, the only tail risk they typically have is cash. They sit on some cash. And that's when I would say, what have you done as a result of this? I would just increase our cash. I'm like, well, there are actually some strategy. There's some things you can do, some decisions you can make that aren't career risk decisions that I think would fill a role besides just cash. So sometimes, like I said, I get sort of muted by the host, but I have to carry that banner where I can.
No, fair enough. So
I would also like to comment that this spring's action, didn't bruise private equity investors or private credit investors like a typical recession would. Basically, they never suffered that mark. And the Fed came in way quicker than, and so if we get a double dip and kind of, because there's not much room left, things could be a lot worse for the private investor.
Well, I in early February, I had gone to a conference, private equity venture capital one-day conference at Harvard University, where some of the top industry folks in these areas were speaking, and the consensus at that time, and this was before the full force of the pandemic in North America, was that the market, everything seemed frothy. That was the and so. It is going to be interesting. I agree that, they didn't suffer the mark, and that's sort of, what happens when you're illiquid.
John, but let me jump in for 1 second. Sure. That comment is true across asset classes, right? That is true for public equities. That is true for treasuries and corporate bonds. I think one important concept, and I really appreciate the poll here because it kind of shows that, is what principles are you investing based on, right? So, we manage an endowment in our shop. It's $13 billion. We would answer exactly just like this. We had excess cash. We had tail hedging strategies. We had exposure to treasuries, managed futures, almost everything. But I think one very important principle for us is this long-term expectation. We are not quarter to quarter, month to month. So what we saw this year really highlights the importance of what is your time horizon. If your time horizon is pretty long, we saw a lot of things this year, but it's almost a non-event. It's crazy to say, but it's almost a non-event in terms of a long-term horizon. And volatility changes a lot of the asset classes, even of public equities change a lot depending on your horizon. So, these principles are very important. For us, it's pretty clear. It's long-term expectation and quality assets, right? And so it may be different for different people, but just
no, exactly.
Just to have that clear.
I'm in agreement with you, but a subtle nuance that was embedded in your point, I believe, is that you need to get paid for that in liquidity. You need to get paid properly. Otherwise, one shouldn't be mistaking illiquidity for alpha, right? And so one needs to be very careful when one makes a investment into the privates. It's a longer commitment. It's a bigger commitment because of the time horizon. So one has to be extra careful. Now, just finishing up the poll questions. If no, was your portfolio not liquid enough? And almost 80% said it wasn't liquid enough under that subset. And in general, liquidity, the value of liquidity is underestimated. That's a fact from behavioral finance. And with regards to 2021, it seems like half of the audience believes that the markets, equity markets, the S&P 500 total return isn't going to move that much, and then it's sort of split. Like I guess 22% sort of think that it's going to increase between 5 and 12%. So interesting results there. And then with regards to 2021, it seems like most people plan to position their portfolio about the same, not more aggressively, not more defensively than the current portfolio. So any comments on any of those other poll questions?
Well, other than nobody knows where the equity market is going.
Yeah, that's fair enough. Nobody has the crystal ball. Even though this is a more sophisticated audience, it seems. So let's switch now to some high frequency kind of questions to each of you, and so the first question I'm going to ask, and I'm going to ask each of you to keep it less than 20 to 30 seconds tops. Please share an insight, nugget of wisdom about something you have learned in 2020 with regards to the markets, portfolio management, or risk management. Let's start with Judy.
So I will sort of steal a phrase that I heard at a 100 Women in Finance webinar earlier this week, and that's prepare, don't predict.
Excellent.
Because I think that's really important when you're thinking about portfolio construction. Things happen and they happen fast, and it's almost impossible to be able to react simultaneously. So you have to prepare. You can't predict.
That's a very insightful. Thank you. Rafa.
Yeah, for me, two main headlines I would say. First is the speed of the drop and then recovery. That's unprecedented, and I think it's going to be here to stay for the next few ones that we're going to have. The second one is how active, aggressive, we can put it as we want, or was monetary policy, fiscal policy. That makes a huge difference, right? A lot of the valuations we're seeing right now, it's a consequence of that. So those two were big news, big headlines for me.
Great. Brian.
Yes, I would say that one of the things what I've learned is that facts often masquerade as certainty. And I think we need to be flexible. We need to be willing to be wrong. I think that lots of family offices are not flexible, and they're not willing to be wrong, and to understand and recognize their shortcomings, own their mistakes, and build accordingly.
Great, John.
I like that, Judy. Prepare, don't predict. And so I would say, first order, you got to prepare your portfolio for the uncertain. Second order, your managers, have to react, to what has occurred. because you as an entity likely are not going to be able to react in the time scale that is useful. And then tactical, at the opportunistic level, you're going to need at least a week or two as an organization, as an asset owner, to react tactically to opportunities that, and it's really not that important to be that quick typically. But those, thinking of the investment problem in that three parts, is unless you are an infinite investor, then you can just put it all in equities and go to sleep.
Okay, so now, no, thank you. Now, sticking with the high frequency, because what I want to do, finish up the questions we have, which are almost done, and then we'll go a little bit over time, because we're getting some pretty nice questions from the audience, but I won't. We won't go too much into it. One word answer here: 2021. Inflation, stagflation, or neither? Judy.
Neither.
Rafa.
Same boat here. Neither one of those.
John.
Disinflation.
Thank you. Brian.
Neither one.
Great. Okay. Now, in honor of the late Alex Trebek, who's a Canadian and University of Ottawa alumni, but also beloved in both the US and Canada, we're going to end with a Jeopardy-style question. So 2021, 2022 saw this bubble burst. Judy.
What is private lending?
Rafa.
What is growth?
John.
What is globalization?
Brian.
What is Duke basketball? Oh, no, wait. What is passive management?
Okay, thank you. Okay, so we are going into, we're going to go into some of the audience questions now, and we got a whole lot of them. But so maybe this, I think Judy will be good to answer this one, but anyone can jump in. The conversation around factors is based on the assumption an institutional portfolio with various investment structures, so PE, hedge funds, venture capital, equities, etc., truly knows and quantifies and a number of key factors. How often is that true? How have institutions modernized their risk management for a true understanding of risk?
That's a great question. And I think it is true that a lot of institutions have modernized and the risk systems are much more sophisticated than they used to be. It's sort of going back to the asset allocation or portfolio construction perspective, that if you're just looking at asset classes, it's too broad. You're not really picking up the exposures and the risks that are involved. You're much better off to focus down on the risk exposures, the factor exposures, and so forth. And then you get into situations, though, we didn't get to the question that we had sort of had on the list of, factor rotation or factor timing. Can you do that or can't you do that? But that's all part and parcel of the same sort of perspective there, and looking at what the exposures actually are in an institutional portfolio.
Great. No, thank you. That is an excellent question, and I'd love to. I'm going to resist addressing it because I'll take too much time to answer that. But what about fixed income relative value? So there's the suggestion that this is a very interesting strategy, uncorrelated returns. You agree or disagree? Any quick?
Very uncorrelated until it matters.
Yeah. Okay.
Anything that has high leverage ultimately is unreliable. And when effectively there's a crisis, the macro element is the only thing that matters. What the growth exposure is versus the rate exposure versus no exposure. But strange things happen when there's leverage.
No, excellent. Okay, there's a question about taking tax considerations, but I'm going to pass on that because that always depends on the specific cases and jurisdictions. And
just say yes.
Yeah. Well, none of us. I'm not a tax expert, so I'm not, and I don't. So I think we'll pass on that. Why are family offices and institutions so reluctant to hire a consultant that understands unique strategies that provide true alpha and diversification? I don't know if that's the question. I read it verbatim. I don't know if I agree or disagree with that, but that was the question. Anybody? Brian, do you want to handle that?
I think that, a lot of family offices, this is just my experience, it's one man's take, but lots of consultants struggle to convince or able to convince family offices to do something that's different. Because different, by definition, prima facie means that some of them are not going to perform well or not going to perform. I mean, there's just, and so if they're not going to present different, they're going to present trophies. And do you need consultants to, find the names that you can find yourself? So there's this tension of, will family offices embrace this idea? Are there consultants out there that will truly bring different, not just the latest Bitcoin or cannabis manager, but like somebody that's different? And it's really hard to find that. Yeah. Finding different is really, really hard. Everybody wants it. No one wants to do the hard work. And they hire consultants, and you've got to find the ones that's willing to show and present to you different, and find a family office that will go, oh, okay, because they prefer a story. And sometimes stories win over a process. Like I know this is you hear this a lot, but favor process over outcomes. And that is a tough thing to get family offices to embrace, but it's absolutely true.
Yeah, no, fair enough. Okay, I'm just going to ask a couple more. With the introduction of illiquid investment structures and asset classes and institutional portfolios, how do you address the challenge many risk ratios are underestimating a portfolio's true risk when constructing a portfolio or providing updates to key stakeholders?
Rajan, maybe I can take a step on that. Sure. Some years ago, I did one analysis about liquidity capacity for most of the institutions, and a lot of people underestimate the capacity of holding the liquid assets that they truly have. If you think of an insurance company, a pension, or a lot of absolute return investors, they have a little bit of an aversion of illiquid assets because of this underestimation of the capacity they can hold them. If you run multiple scenarios and think about when they would run into these illiquid situations, so kind of fire sale situation, doesn't happen very often, and very few and far. So I got to say that a lot of people underestimate that, and that's to the detriment of returns.
Yeah, no, that's a great point. And at Bodhi Research Group, we've done a lot of work on liquidity management and the mathematics of liquidity. And I would also suggest maybe partitioning the portfolio into different liquidity buckets and looking at it with a different liquidity lens in terms of some of the risk ratios, and that can also provide a clearer picture. And so that can be.
Let me just add one thing that I think was maybe forgotten from 2008 was that people suffered capital calls right in the worst of the situation, sort of in October, November of that year. And I think that's been forgotten with the increase towards illiquid investments for a lot of people, that there is that still risk that at the very worst possible time, you may have to come up with cash to meet a capital call. And that can have serious effects, which we saw on a number of endowments in particular after 2008.
No, absolutely. I mean, it has to be carefully calculated into and embedded into one's proper cash reserve. Otherwise, it can lead to a liquidity mismatch. So the next question, we just have two more, and then we'll end it. What are your thoughts on CTA strategies? We did make a few comments about that. Anybody want to make any more?
I mean, I'll jump in. I think that they are, they can't be relied upon to be positioned correctly in the first order, but typically they're very good at taking advantage of the second order, meaning reacting, and repositioning if a crisis truly turns into something more nefarious than just a blip.
Brian, did you have something to add? Or?
Yeah, I'm obviously biased. I've had, in my whole career, we've been investing in CTAs, and I think that they provide a meaningful addition to a portfolio. I think a basket of managers that have different approaches. I mean, I just think that some of the performance characteristics of long-term trend followers, diversified long-term trend followers, are very helpful. But there's a number of really well-known that you could build a basket. And there are also firms out there that can help provide a solution. And I think that in the search for new, we often overlook the search for effective, and I think they can be an effective addition to a portfolio that is worth really exploring. And there are great solutions out there that have been around a long time that provide, I think, a meaningful addition to a portfolio.
Yeah, and I would echo that, and I would say,
I would just add one thing to that, because I think that's exactly right. A portfolio of a group of them, and particularly some of the ones that have been around for a long time and have been through a lot of things. The only thing that I would watch for is go back and really go through their performance in tough times, because I think for a lot of them, particularly in the last, it's getting now almost 30 years, it's been duration has been what's really helped them, particularly during those flight to quality times. So you may be able to get that same sort of exposure through, John's long treasuries portfolio, and probably maybe even a little bit cheaper, and have the liquidity there. So that would be the one thing I'd watch for.
Well, I think I would state, like, I don't fully agree with that statement, but we can take that offline. And I would state that what's really happened in the managed futures industry is that it's expanded a lot in terms of a lot of different kinds of strategies and styles. So in that sense, I do agree with Judy in that one has to be very, very careful what manager one is selecting, because there's a lot more differences now and a lot more nuances in terms of how the manager will fit in and what role it'll play in a portfolio.
And Roger, if you clear a little bit, the water and look at premiums, right? What premiums are you actually getting? Are you getting trend following, momentum? The only thing I would ask people to think about is not to put all their eggs in one basket, right? If not, you want probably have a diversification across premiums. So sure, go for it, but add value, add defensive, add low volatility, protect yourself in some way as well. And there was a lot of reliance on just trend volume.
I would comment that for CTAs, it's really important to understand what their role is, right? I mean, is their role an alpha driver? Do you want them to make money all the time? If you do, that's going to be a very different manager than effectively a systematic trend follower, which really it should be a positive skew manager, make money when you really need it to. And then, we run a strategy that effectively is, a CTA, but it never positions short duration. It's always just either flat or long duration, so that it is basically you understand why you have it, and you understand what it can do and what it cannot do. That's really, really important. We sub certainty for the idea that you want to make money all the time, which is just not possible unless effectively you're generating quote unquote alpha, and alpha is unreliable.
Yeah, I mean, you got to be understanding the investment, and absolutely, if you don't understand the investment, and trend following isn't something that is clipping coupons and getting you a plus 1% each month. It's lumpy returns, but you have to. This should all be process driven in terms of looking at how you're going to be evaluating your managers under what time frame and so forth. Last question. I read that family offices and institutions are piling into PE. Is PE materially different from public equity markets, return and risk? Do you see this piling in as a future problem and disappointment? And Brian sort of answered this, gave his opinion earlier. Does anybody have anything to add? Or Brian, do you want to echo what you stated earlier?
I mean, it's not popular, and I think it has a place like everything else, right? I just tend to look at, I'm just not in the kumbaya camp that this is the end all be all. I think whenever I say it's leveraged illiquid beta, people get very upset. So it has a place, and we do some in our family office, but we don't do as much, and I'm not drinking the Kool-Aid. It's not, I'll just leave it at that.
Look, I want to say something about that. depending on your time horizon, they become more similar and more similar, right? That's a very important point. The other thing that I would highlight too, there are things that private equity managers do and can do that public equity is really hard to do. It's been really participating on the growth of the company, on how the company is ran and all that. So they're different investments. So, I would encourage you to be careful with valuations, of course, but they're not the same thing. But with the horizon, they become more similar for sure.
I would agree with that 100%. They aren't exactly the same thing, and they do provide exposures to places in the market that you really can't get in the public markets. However, one should be aware that on a risk basis, if you're, that they're equity. They're equity. It's right in the name. It's equity. And so recognize that you're not diversifying away equity risk by investing in private equity. You're kind of doubling it up. And if you're okay with that, that's fine, but recognize it.
Yeah, I think it definitely does have a place in the portfolio. But it goes to all of what you're all stating about proper and prudent asset allocation, and due diligence, and knowing how it fits in, and with the rest of your portfolio as well. So we have gone over time by 13 minutes on Friday, November 13th. I'm going to, take one last opportunity and thank all of the panelists, Judy, Brian, John, Rafa. You guys have been wonderful, very insightful, and I thank Meg for putting it all together, and most of all to the audience. So thank you all.